Gold is a warning sign, A, that the Fed has got the policy wrong, that these rate cuts are a mistake, and that, in fact, rates are too low and they need to be raised. But I also think it's a bigger warning. The world is getting rid of the dollar. That foreign central banks, foreign governments are losing confidence in the dollar. Everything that they're going to do as a result of what's going to happen is going to make what's going to happen worse. I think gold is going to be worth, at a minimum, half of the Dow Jones at some point. So I mentioned that the Dow was at 45 ounces of gold, 1999, and now it's 11. So I think it's going to be down to 2, probably maybe lower, but let's just call it 2. So where would that be? Well, if the Dow went to 20,000 and gold went to 10,000, that would do it. But, that would be a big bear market. The Dow's like 46,000. So it has a long way to fall. Let's say the Dow goes to 50,000. Well, now gold has to go to 25,000. And now you got 2 to 1, right? So that could be, a way it happens. Or the Dow goes to 40,000 and gold's 20,000. Or it was 25,000.
Gold is quietly signaling what few on Wall Street want to admit: a full-blown monetary shift is underway. The Dow-to-Gold ratio continues to collapse, suggesting that gold is reclaiming its dominance as the accurate measure of value. If history repeats, we could soon see gold trading at half the value of the Dow, or even reach parity as it did in 1932 and 1980. Whether the Dow falls to 20,000 or gold rises to $25,000, the message is clear. Fiat money is losing credibility, and tangible assets are regaining their rightful place in the global system. Peter Schiff, one of the most consistent and outspoken advocates for sound money, warns that the world is abandoning the dollar standard for a gold-backed framework, just not one led by the United States. Central banks are reducing their exposure to treasuries. Major institutions are pivoting to gold, and even Wall Street's most prominent players are sounding the alarm. Schiff sees this as the beginning of a generational bull market in precious metals and a defining moment for global finance. The monetary reset isn't coming. It's already started. Now we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
I think that gold is going to be worth, at a minimum, half of the Dow Jones at some point. So I mentioned that the Dow was at 45 ounces of gold in 1999, and now it's 11. So I think it's going to be down to 2, probably maybe lower, but let's just call it 2, right? So where would that be? Well, if the Dow went to 20,000 and gold went to 10,000, that would do it. But, that would be a big bear market. The Dow's like 46,000. So it has a long way to fall. Let's say the Dow goes to 50,000. Well, now gold has to go to 25,000. And now you got 2 to 1, right? So that could be, a way it happens. Or the Dow goes to 40,000, right? And gold's 20,000. Or it was 25,000. Well, if you look at the last 2 major declines in U.S. stocks, they ended with the Dow and gold at 1 to 1. That was 1932 and 1980, right? At both of those major stock market bottoms, you could buy the Dow for about an ounce of gold. So I'm not saying that the Dow should be worth 2 ounces of gold. I think it would be cheap at 2 ounces of gold. I'd be happy to buy the Dow at 2 ounces of gold. I'm just saying that if we get the type of decline that I think, the Dow's going to get very cheap. It's not going to, the bottom of this bear market, it's not going to be fair value. Stocks are going to get ridiculously cheap at the bottom, just like they're ridiculously expensive at the top. But, depending on how much money we print, if we were to go back on a gold standard, I think you'd probably have to have $20,000 or $30,000 gold at this point to make it work, based on how much debt we have and how many dollars are out there. And I do think the world is right now going back on the gold standard without us, right? I think foreign central banks are, going to be backing their currencies predominantly with gold. They may not make them convertible into gold, but their primary asset that they will hold to defend the value of their currency will be gold, not U.S. dollars. And what that means is they're not buying any more treasuries. And you know who else is not buying treasuries anymore? Maybe Americans. Morgan Stanley, just a couple of weeks ago, their strategist said that we should recommend, instead of a 60-40 portfolio, 60% stocks, 40% bonds, 60-20-20. 60% stocks, 20% bonds, 20% gold, which is a sell signal on bonds. Sell half your bonds and buy gold. Now, if Wall Street does that, if the average American who has a 60-40 portfolio makes it into a 60-20-20 portfolio, I mean, that means Americans are going to go on a selling spree, getting rid of their bonds and just buying gold. So how is the U.S. government going to finance these massive deficits if nobody wants to buy the debt they're selling? That's the problem. That's why the Fed is going to crank up the presses and do massive QE. But that's just massive inflation. That's just throwing gasoline on this bonfire. And, you know, Jamie Dimon, just today I read a quote. Jamie Dimon said he thinks gold can easily go to 10,000, which, you know, can go a lot higher than that. But here's what Jamie Dimon said. He said for the first time in his career, it's not completely crazy to have some money in gold, right? Now, it's never been completely crazy. In fact, it's been totally sane. Jamie Dimon just didn't understand why. Like when guys like me were telling people to buy gold when it was 300, 400, 500, 1,000, right? It was because Jamie Dimon didn't get it until just now. Now he's starting to worry about the stuff that I've been worried about for 20 years. Now Dimon is finally worried about it. But now more people on Wall Street are starting to worry about what they should have been worrying about all along. The problem is now we're so far down this rabbit hole, there's no way out of it, right? So it's, you know, when I first started talking about this, it was early enough to do something to prevent the crisis. Now, all you can do is, you know, buckle up, right? The crash is coming. So yeah, you got to buy gold. You got to buy silver. People should go to Schiff Gold. You know, in fact, I tell people now when I do interviews, if you're watching this interview, don't even wait till the end. Put it on pause, go to Schiff Gold and buy some gold and silver. Because if you wait till the end of the interview, it'll be more expensive. So just go in there and buy it now and have some real money. And then, you know, also, I think people should be investing in foreign stocks, gold stocks. I mean, gold stocks, you know, have more than doubled this year. I have stocks I own that have tripled and quadrupled, but they're still cheap. You know, this is just the beginning. Hardly anybody owns these stocks and hardly anybody owns gold. We are at the very early stages of what is going to be a generational bull market in gold and silver and these mining stocks. This is really the first year of the bull market, you know, but it's not going to end in 1 year. It's going to last, I think, for the rest of the decade and probably most of the next. Gold is a warning sign, A, that the Fed has got the policy wrong, that these rate cuts are a mistake, and that, in fact, rates are too low and they need to be raised. But I also think it's a bigger warning that the world is getting rid of the dollar, that foreign central banks, foreign governments are losing confidence in the dollar as a stable long-term store of value. They have no confidence in the fiscal responsibility of the United States Congress or the president to get his house in order. And they're losing confidence in the independence of the Fed, which is being, beat up constantly by Trump, putting political pressure on the Fed to cut rates, print money, create inflation. And so I think the world is moving away from the dollar. And we haven't seen this kind of movement in the price of gold since the 1970s. This is the best year for gold. Gold's up almost 60% on the year. Oh, and you have to go back to the 1970s to find a year where that happened. And there were several years during the 70s when that happened. But the significance of the 70s is we went off the gold standard in 1971. And when we did that, it was a game changer for the monetary system, and the dollar lost a lot of value. And so gold went from $35 an ounce to $850. But what's happening now, I think, is just as significant, maybe more so, because now it's not the U.S. that's going off the gold standard. It's the world that's going off the dollar standard. And what this means for America is a complete collapse in our entire economy and our standard of living, because over the past 50 years, we've grown completely dependent on the dollar's reserve status. That's how we're able to live beyond our means. That's what makes these trade deficits possible. That's why we can buy stuff, consume what we don't produce. That's why so many Americans can borrow without anybody saving, because we're tapping into the rest of the world's productivity and the rest of the world's savings. And the vehicle to do that is the dollar and its status. Well, as the dollar loses that status, our ability to rely on foreign production and foreign savings is gone. And that means our whole economy implodes, because without foreign production, foreign factories, we can't produce the goods that we consume, and we don't have the savings to finance our massive debt. And so we're headed for an economic crisis much greater than the 2008 financial crisis. That is what gold should be telling everybody, that a monetary crisis, a U.S. dollar crisis, a debt crisis is just around the corner. Right? This is the economic, canary in the coal mine that's dying here. And I think this is a bigger warning than the subprime blow up in 2007 was about the financial crisis that hit in 2008. And when the subprime market blew up, it was obvious to me what was coming, because I had seen years in advance that the subprime market would implode. And I knew that a financial crisis would follow. But most people on Wall Street, including the Fed, actually had no clue. Even when subprime blew up, Ben Bernanke said, "Don't worry about it. It's contained." And I knew that was nonsense. Well, the same thing is happening now. I've been waiting for years. I've been predicting for years what is happening in gold would eventually happen. It's now happening for the very reasons I always warned that it would happen. And now what it is confirming is that the currency and sovereign debt crisis that I've been warning about for decades now, not just years, is finally upon us. And it should happen maybe as early as next year. Everybody needs to own gold and silver. I mean, I've been saying this for 20 years.
The roots of today's economic crisis reach back to a deliberate distortion of money itself. When the United States abandoned the gold standard in 1971, it severed the dollar's final link to real value. From that moment, inflation became policy, an invisible tax designed to fund endless deficits and government expansion. What was once sound money backed by tangible metal became a promise backed only by trust. Over the decades, that trust has been eroded by reckless spending, rising debt, and political manipulation of the monetary system. Now, as the national debt explodes and the purchasing power of the dollar collapses, the same government that created the problem is preparing to blame capitalism for the fallout. The truth is the opposite. Capitalism didn't fail. Currency integrity did. The real defense isn't found in paper promises or fiat illusions, but in assets that can't be printed away, gold and silver. The system is cracking, and history's lessons are repeating once again. Let's get back to the interview.
Because when we have this economic crisis, the government's going to blame it on capitalism. And I want as many people to know that the government caused the problem, and the only solution is capitalism. Right? Not more government, but less government. But people need to protect themselves. They need to protect themselves from the inflation and what it's going to do to the typical American. So you need to get out of bonds. You need to get into gold. You need to get into silver. You need to own real money as your savings, not fiat. And go to Schiff Gold. And yeah, I mean, if you have money in crypto, you could take some of your crypto, as you said, and buy some gold or silver as a hedge, just in case your crypto collapses too. You might as well have some gold and silver. We make it easy to get out of crypto at Schiff Gold because we work with BitPay. We were one of the first companies to work with BitPay, where you can check out, you can go online, buy some gold or silver, put in a shopping cart, and when it comes to checkout, you can go to pay with Bitcoin, and you can use your Bitcoin. The dollar was legally defined as a weight of gold or silver. So that's what a dollar was. It wasn't that dollars were backed by gold. The dollar was gold. The dollar was silver in the same transaction and get gold and silver. And, if you have a larger portfolio where you just don't want to have all your money in physical gold and silver, you want to have stocks, you want to get dividend income. I have mutual funds. I have an asset management company. That's really my bread and butter as basically a private banking syndicate that issued notes. Again, those notes were not dollars. And in fact, even if you take a Federal Reserve note today and you look at it and you read it, it says this note is legal tender. it doesn't say this dollar is legal tender. It says this note, and gave everybody $20 an ounce. And then after they got the gold, they devalued the dollar and said, okay, the gold we just took away from you is now worth $35 an ounce. And that gave the U.S. government a lot of extra money to spend to try to stimulate the economy. That was how they ran this stimulus. Roosevelt didn't tell people what he was going to do with the value of the dollar once everybody turned in their gold. And a note is a promise to pay. Originally, those promises paid dollars. The dollars were gold and silver. Now, in 1933, during the Depression, Roosevelt suspended the convertibility of notes to lawful dollars, and in fact made it illegal for Americans to own gold. And so you can no longer take your Federal Reserve note to the Federal Reserve Bank and get gold. They wanted to do a big stimulus, but they didn't have the printing press the way they did today. We were on a gold standard. And so Roosevelt basically took everybody's gold, but he never did this, to foreigners. So they never suspended the convertibility of the dollar to gold for overseas holders of these notes. And in fact, when we had the Bretton Woods at the end of the Second World War, where the world agreed that we would have this monetary system backed by the dollar, right, the Federal Reserve notes, even though American citizens couldn't take them to the Fed and get gold, the Germans, the French, the Japanese, the Italians, any other foreign bank that owned the Fed, had Federal Reserve notes, could go to the Federal Reserve, and if they gave them 35 notes, $35, whatever, they got an ounce of gold. That was the deal that we made with the world. In fact, the Federal Reserve note was really like a bond and a promise to pay a quantity of gold. And so that continued up until the late 1960s. And the problem was during the 1960s, the U.S. government really started to run large budget deficits. Not by today's standards, but by the standards back then, because we were fighting the war in Vietnam. We were fighting the war on poverty as part of the Great Society programs. We were funding the space program. The government was spending a lot of money and running deficits. And so the Fed was printing money to fund them. But we didn't have the gold. We didn't have enough gold to back up the notes. And a lot of foreign countries recognized this. And they said, we don't think America has the gold. So we're going to go get it. We're not going to hold these Federal Reserve notes. We're not going to wait for America to default. We're going to take these notes to the Federal Reserve right now and get our gold. And so that started to happen. And so all this gold started to leave the U.S. Because the world rightly didn't trust us anymore. Now, Nixon had a decision to make at that time, right? Cut back on government spending, right? Balance the budget, act fiscally responsible so that the gold doesn't keep leaving, maybe devalue the dollar, to a new lower level. So make gold more expensive because they had printed so much, allow a deflation to take place. Basically Nixon could have done the politically responsible thing, but why would he want to do that? Right. So they tried to think, how can we, continue to run these big deficits and not have to be responsible? And they said, well, let's just temporarily close the gold window. It was supposed to be temporary. Let's stop the bleeding by let's just default. Basically what they did, we're not going to let you get any gold for your dollars anymore. And so that's what he did. 1971 said, we're not going to honor these notes now. So if you have $35 or $42, because we devalued a couple of times, but if you have $42, you can't take them to the Federal Reserve and get an ounce of gold. You can't get anything, right? So if you've got $40, all we'll give you is 220s or 410s. We're not going to give you any gold. And so as a result of that, the dollar crashed during the 1970s. The dollar lost about 2/3 of its value against other fiat currency.
What?
It went down about 2/3 against, the mark, the franc, the yen, the pound. But Against gold, that's where you really saw the loss, because it went from basically $35 an ounce at the beginning of the decade. You needed, at the peak in 1980, you needed $850 to buy an ounce of gold. And that's why oil prices were $3 a barrel in 1970. They went to $40 a barrel in 1980. Now, a lot of people back then claimed that it was the Arab nations, right? They were the ones that were screwing us by jacking up the price of oil. But that's not what happened. We tried to screw them over by giving them paper for their oil instead of gold. And when we were paying real money, they were willing to sell us oil for $3 a barrel. But that's when it was gold. But when we tried to just give them paper that we were cranking off the printing presses, well, now they needed $40. Right? It's not their fault. We changed the rules. We debased our currency. We can't expect them not to raise their prices to compensate for that.
Every financial crisis begins with the same illusion that governments can print prosperity and borrow without consequence. The U.S. has now crossed a point of no return as inflation and debt spiral together. The collapse of purchasing power isn't an accident. It's the byproduct of decades of deliberate policy. Each new round of stimulus and rate manipulation only accelerates the erosion of the dollar's credibility, setting the stage for a global monetary realignment. Peter Schiff has long warned that inflation isn't just a number. It's a transfer of wealth from savers to debtors, from the productive to the political. And as the dollar weakens, gold is once again emerging as the ultimate refuge for real capital. The coming decade will separate illusion from value, speculation from substance. Those who understand this shift early will protect not just their savings, but their sovereignty. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.